The following is paid programming. Welcome to Something More with Chris Boyd, certified financial planner practitioner and founder of Asset Management Resources, LLC, a registered investment advisor firm. We call it Something More because we like to talk not only about those important dollar and cents issues, but also the quality of life issues that make the money matters matter. Here he is, your fulfillment facilitator, your partner in prosperity, advising clients across the country, your host, J. Christopher Boyd.
Hi, everybody. I'm Chris Boyd. I'm here with Jeff Perry. Thanks for being with us. We're joined by our firm's Chief Investment Officer, Brian Regan, who hasn't been here in a while. Thanks for being here, Brian.
Good to be here, guys. How are you?
Very good. It's good to have you
Yeah.
on. And, I thought we'd jump into questions about market activity. There's a lot to discuss. We haven't talked about it in a little bit. Market's been pretty volatile. I noticed although we're up for the year, we had a decline from the markets in August. Often people worry about September as one of the most volatile months. So I saw something 45% of the time I think it's positive, but it often ends negative. So, it stands out in our minds. September, October, these are often months we tend to worry about. So I thought just a little bit of commentary about what's going on in the market, what's happening in the economy, and things of that sort might be a great place to start with us. So, Brian, should people be worried about market declines as we look forward the remainder of the year? We had a great start to the year in the first half, but does that mean it's inevitably going to be harder to see further gains as we proceed?
Well, that's a difficult question to answer. Obviously, it's very short term. I mean, we're talking about 4 months for the rest of the year.
I think the answer is not inevitably, is what I would say. But there are definitely reasons to pay attention, right?
I mean, I can make arguments for the bull side and the bear side, right? I mean, the bear side would be interest rates are higher, valuations are higher relative to interest rates. So you would think that a pullback could be reasonable. On the other side, there's the idea that, if you're a growth manager and you're lagging the NASDAQ 100, for example, which is up a whopping 41% this year, you might have to chase some of these stocks and bid them up before the end of the year so you can say that you've owned them or in order to try to catch up, right? And that would be bullish. Usually at this time, if it's a down year like it was last year, my personal sentiment is likely more negative because I think there's going to be a lot of tax loss harvesting. I think we saw that in 2018 or 2019, and then again last year. So, I think that's a bigger driver going in the year end than, what you see in an up market. So, I think it's anybody's guess in a 3-month period, but, I personally would be a little bit more cautious just because at 4,500, with interest rates at 4.30 on the 10-year, it's hard to get your numbers to foot where that valuation makes sense. You can come up with a really good scenario where it does, but it's probably not likely. And I think we've seen that a little bit here in August. We got a little bit of a pullback in the S&P 500, to the tune around 3%.
Along these lines, just as an aside, Barron's had an interesting article last week where they said the headline for this lead article was "Fall Market Outlook: Stocks can rise further, but a more measured pace." But at a more measured pace,
I love articles that say that things could happen.
Yeah.
Almost anything could happen. That's real helpful.
It's like watching the weather, right? It's going to be partly sunny today with a chance of rain this afternoon.
Right. That's basically what it's saying, right? Like there's a 30-40% chance of rain, I guess. Full transparency, and this is in our webinar, we are underweight stock right now. We're a little bit underweight beta, so we're positioned a little defensively, versus where the market is on basically all of our strategies. So that should tell you a little bit about how we we think the market should go for the
that's a good point.
the data is right now.
Can I go back to an old question that it's not an old question, an old issue? The inversion of the yield curve, that was talked about a lot, and it's still inverted, but we were all worried about when it went backwards, I guess, so inverted, that a recession was coming, the market was going to decline because of it, and all this history stuff. Are you looking at that, Brian? Is it still inverted? It usually means something negative, but how do you view it now?
Well, the inversion of the yield curve basically means that in the future, the market expects Fed funds to come down. Now, what it's saying, and the reason why it's an indicator of recession, is because when is the Federal Reserve going to lower interest rates? Well, or dramatically, it's likely going to happen during a recession. So that's why it's a leading indicator of recessions. But the yield curve inversion could resolve itself two ways, right? It could do it the traditional way, where we have a recession and the Fed drops Fed funds dramatically, or you could have longer term rates rise. And right now, I think what we have been seeing is longer term rates are rising in the face of the fact that the economy has been very strong. The Atlanta GDP has doubled the estimate for the third quarter that the Federal Reserve was expecting. I think the latest estimate was over 5% for the third quarter, which I don't need to tell you guys is still very, very hot. But at the same time, we do have measured inflation. So, what we've been seeing is there was a big difference between what the stock market was doing and what the bond market was doing. And I think one of those had to meet the other. And what we're seeing is the bond market's probably going to come up to meet the stock market. And the reality is they might just meet each other in some equilibrium, which I think is going to be a trading range that we've probably have been seeing here for the last couple of years since inflation peaked.
Brian, you'd talked last year quite a bit about the idea that recession was maybe overstated. You had mentioned to us that this is something we should probably be talking about a little bit more this year. Do you want to transition to that kind of a discussion?
Well, I think it's pretty clear that it was overstated, right? This is something I've been thinking about a lot lately. It's, if you are bullish and the market's going down, are you always wrong? Well, I would take the position no, right? The market seems to be, in hindsight, that it was wrong last year, right? It was way too bearish,
right? Too pessimistic,
and that really snapped back in 2023 as inflation came down, and that's very interesting to me, right? So if you're a manager and you were taking it on the chin in the second half of last year, well, now you're reaping the benefit of your conviction, and that's a really difficult thing to do. Now, at the same time, if recession was overstated in 2022, well, now it might be a little bit understated. I think there's this perception that there's nothing to worry about. I think persistent higher rates is certainly something to worry about. The unemployment rate ticked up, which was good for inflation. We have more people coming into the labor force, which is great for inflation. It puts downward pressure on wages, but that also puts downward pressure on consumer spending, right? So if your wages aren't rising as fast, then consumer spending is going to go down, and that is relatively speaking year over year, and that is going to be negative for GDP. So that's a bearish scenario. We know that residential housing is a big part of the economy. And what did we see during the pandemic? We saw household formation boom. And then I think a lot of the purchases and products associated with that have been pulled forward over the last couple of years since the pandemic. And at some point, that's all going to settle in. We also saw services boom more recently. And right now seems like a good time to buy an airline ticket, for example, right? They seem to be coming back down into reality. So this is all to say that we had a boom, and maybe we're still in that boom, But there's a strong possibility we could be at the tail end of that boom, right? We still have issues such as 7.2% mortgage rates. Yes, it's true that we have limited supply, so that the housing problem hasn't been a big issue, but that's going to limit the household formation that I just talked about. We have car loan rates between 5 and 6%. That's significantly higher than 0% that you could have got a car loan rate for 3 years ago. We have, these are all things that just put downward pressure on the economy.
As Jeff has talked about in recent weeks, I think there's that point that, let's face it, the consumer debt has really increased, and we've got a lot of maybe less capacity than we had for people to spend because of, they've been raising their credit card debt and they burned through some of that savings that people had for a time.
And also, let me add one more on that, is that we're just starting to get into the time period of where student loans are heading back to repayment. And so that's going to take cash out of the retail sector, if you will, or the dining sector or the services sector or wherever these people with student loans would be spending that money. A lot of it's evaporating into loans being repaid.
I haven't studied the crop. Maybe Jeff has studied it a little bit closer than I, and I know that it has gone up. I looked at the New York Fed data that came out not too long ago. But I think it's important to note that it always goes up. It goes up with population. It goes up with incomes. The more important thing is
some of it is just naturally going to go higher.
It is naturally going to go higher, and that's not necessarily a bad thing, right? So you kind of want to look at it as a function of defaults or payments, on-time payments, and things like GDP or household disposable income to credits to interest service. So all that stuff is readily available, and I think the last time I looked, it's all relatively healthy, which is good news, right? But in general, I think your point is well taken, Jeff. That credit card debt is always something to be concerned about.
Brian, to your point about interest rates, and I've been thinking about this a lot. So certainly rates are much higher than they were a few years ago when we were in this 0% kind of mode. If we look back at history, though, and we say, okay, we're in this time period of history with 7% 30-year mortgages, 4 or 5% car loans. People are getting a little bit of interest at the bank, and money market accounts are paying 4 or 5%. That's not historically high. You wouldn't look at that context and say, well, that's an environment where the economy is going to have to slow down.
I don't think the actual level is the thing I'm most concerned about. I think it's the pace of change. So if we moderate at a certain point, that's great. I think people can get comfortable and adjust to the new rates. I think prices will adjust to the new rates. That's the same for inflation and rates, by the way, right? If we have stable inflation at 3%, then you can build your capital project models to expect
figure it out,
inflation rate forever. But if you have a wildly changing inflation rate, everything just becomes a lot more difficult, and it becomes harder to pull the trigger, and it suffocates growth. Which is why the biggest reason why the Federal Reserve is so hesitant to move off that 2% target, even if it might be reasonable to do so. They want a stable long-term inflation rate. Now, you're right. The rates where they are historically are not high, right? In the late 90s, early 2000s, Fed funds was north of 6%. I think the 10-year was also north of 6%, which is significantly higher than we were now. But it was like that for a while, right? We had maybe like 20 years, it was kind of increasing at that pace. But the long-term trajectory was still down from the late 70s to the late 90s. But there was a long-term stability that people got comfortable with, right? So the key to that is when you have, let's say a mortgage was 9-10% in the late 90s, right? The prices adjust to that. So it's about affordability more than it is about the actual level of costs. So right now, we had a boom in housing, and now we also have a boom in interest rates, and affordability is nil. So that means that household formation is likely going to, slow down, in my opinion, from where it was.
Well said.
Well, let's take a moment to remind everybody while we're talking about a lot of these issues related to the economy and markets. It's not always easy to do things on your own. And if you have a little need for help in the process, you can certainly reach out to us at AMR, Asset Management Resources. We're available at amrfinancial.com. And you can check out commentaries. Brian often has commentaries on our website, on our either on our blog or where he's been published, frequently published on the Streets Retirement Daily. So check that out. Additionally, if you need help, we can have an opportunity for a personal consultation. Happy to talk to you about that. Do want to also remind everybody that we have a upcoming webinar on September 20th. This is one that's more focused on activities for people doing their financial planning as they approach retirement. It's almost actually today, I think, football season.
It is.
Kicks off
tonight. Yep.
No pun intended. So anyway, we've titled this program Retirement Red Zone. So it's a financial planning webinar, and if you'd like to benefit if you're in that last 5 years or so as you get close to retirement, that red zone of your retirement, the last 20 yards, but whatever that is for you. So you might want to check this out, and you can register for that as well on our website. Learn more about it. It's at amrfinancial.com.
Chris, I also think it's great for people who are in retirement. They went in with a plan, they went in with a strategy, they went in with an idea what retirement was going to look like. This is an opportunity to step back and say, am I where I need to be or where I want to be, or should I make some changes? So I think it's broader than just these people might be in the end zone, but maybe they want to take a look around and see if they want to do it again.
It's a long runway in that red zone, right? And in that end zone, right? So even once you do retire, you got to reassess some of these things and make sure you've got everything buttoned up the way you want it. So yeah, great point. Again, September 20th at 10 a.m. if you're available. If for the live interact, you'll have an opportunity to ask questions and things like that. But if you're not, we will record the program and it'll be available on our website as well. Let's transition back, Brian. You had talked about an interesting conversation you'd overheard, and it prompted you to want to bring it up for our radio audience. Let me turn it to you to dig into that.
Yeah. So the reason why I haven't been on the radio for a few weeks is because I was spending some time on vacation with some family and on the golf course and on the beaches. So at one point I was
enjoying Cape Cod, right?
I was. So at one point I was playing some golf at Highland Links in Truro, and with my brother and my father, and I actually brought my daughter with me, which was fun. Oh, and they're interesting people, and they had caught wind of the employment report that came out earlier in the morning. And they were arguing with each other, a friendly argument, as friendly as an argument can be in my family, about I think my younger brother was saying employment was up, or maybe I got that the other way around. My father was saying employment was up, and my brother was saying no, unemployment was up. And I let them fight it out for a little bit because I thought it was entertaining, and then I told them, you're both right. And they were confused. And I explained to them that, yes, the economy did add jobs, but the unemployment rate did tick up because the labor force also went up, and it went up at a faster rate than jobs were added. And I also explained to them that this is a very good thing. And it led to a interesting discussion about what is the labor force? Why do we do a labor force instead of employment or population? And it was interesting. I don't think this is common knowledge to everybody, but to be counted in the labor force, you need to be looking for a job. So it includes employed people, but it also includes people who are looking for a job. If you're not looking for a job, you're not counted. You're not considered in the unemployment rate. So there's a variety of reasons why people might not be looking for a job. Following the pandemic, a lot of prime age women weren't looking for a job. They fell out of the labor force, and that's because I think we can presume childcare was tough to come by. There were a lot of people 55 and older who dropped out of the labor force, and I think we can assume that was because of early retirements or fear of COVID. Working in an office or any type of environment around people with COVID. And those were two big drivers, right? But there's other drivers like incarceration, people going to school instead of working. These are all drivers of changes in the labor force. After the financial crisis, for example, people got discouraged looking for work and decided to go to school instead, for example, and that led to a big drop in the labor force. But what we've seen lately is that people are coming back. The labor force is at an all-time high right now, which is great. So, the wage pressures that we saw because there were very few people working or looking for work are dissipating now or coming down a little bit or moderating because there's more people that are in the job hunt or getting jobs right now than there were back then, which is all good news. So both my brother and my father were correct.
And how did they react? I think they might have said.
I'm all fired up, so it should be a fun show.
Right.
It's nonsense. Bologna sauce.
Did they call you bologna sauce with that, or did they buy into that?
I think my father teed off and started walking, and my brother Paul, he had questions about the labor force. He didn't understand how that could be possible. So I basically explained to him what I just explained to you.
Great. Well, I think it's a good point, and appreciate it. I think we do sometimes get focused on a particular set of data,
right? And
it can confuse. How can something else be true when this is true? And you can have these issues where seemingly competing ideas are still valid. And
well, what I think is interesting, it's almost like whatever you preconceived notion you have in your head, that's what you're going with, right? So if your preconceived notion is that the economy is poor, you're going to say, "Oh, the unemployment rate went up." See what I mean? This is the beginning of the end. Yeah. And if your preconceived notion is that everything's good and dandy, you're going to say, "Look, we added 200,000 jobs." And obviously, there's a lot more in the details than that. And this particular report was actually very good news all the way around.
Well, Brian, thanks for being with us. And thank you all for being with us. Until next time, keep striving for something more.
Thank you for listening to Something More with Chris Boyd. Call us for help, whether it's financial planning, portfolio management, insurance concerns, or those quality of life issues that make the money matters matter. Whatever's on your mind, visit us at amrfinancial.com or call us toll-free at 866-771-8901 or send us your questions to radio@amrfinancial.com.
You're listening to Something More with Chris Boyd, Financial Talk Show.
Asset Management Resources LLC and J. Christopher Boyd, CFP, provide investment advice on an individual basis to clients only. Proper advice depends on a complete analysis of all facts and circumstances. The information given on this program is in the nature of general financial comments and cannot be relied upon as pertaining to your specific situation. AMR LLC cannot guarantee that using the information from this show will generate profits or ensure freedom from loss. Listeners should consult their own financial advisors or conduct their own due diligence before making any financial decisions.